Hi, everybody. Welcome. As you start coming in, we'll start just kind of give an overview of what we're going to talk about today. I know normally we do these webinars on Tuesday at 11, but we had to make a change with some scheduling issues. So thank you for making the adjustment to your schedule. We will be together for about an hour today, just right up until noon. And like usual, what we'll do is we'll start off. We'll go through the slides and the presentation. And then for the last 10 to 15 to 20 minutes, we'll open up for Q&A so you can ask any questions that you want. Before we get started, on the bottom part of your screen, if you click on the Q&A box, you'll be able to submit a question. You can either do that anonymously, or if you don't check anonymous, it will show your name. Then when we get to the Q&A part, we'll just read the question. We won't announce who's saying it or who's asking it. And then just to make sure, given this is a Zoom webinar, can everybody hear me, see my face, see my screen? If you could give a raise your hand or a thumbs up or some indication. Thank you. I'm starting to see. Yeah. Okay. Awesome. All right. So let's assume, I'm going to assume the technology is all good, and we will go ahead and get started. So the title of this webinar is Unlock Your Financial Future, a comprehensive guide to Roth IRAs. And I would say that of all the questions we get from clients across the board, Roth IRAs are probably the one we get the most questions on. And so we thought, why not devote a webinar to discussing Roth IRA, something that could be visited by clients who weren't able to attend so that they can get better educated on Roth IRAs, how they work, all those good things. So that is what we're going to do today. So we're going to start with an introduction to Roth IRAs, just what it is, cover the basics. Then we'll go into some of the benefits of Roth IRAs, compare the Roth to the traditional. There's still, I think, a fair amount of confusion over how these two things differ and how they interact. Then we'll talk about Roth IRA conversions and how those work, how you get money out of the Roth, right? What are the rules around withdrawing money from the Roth? And then we'll finish with how Roth IRAs fit into your overall retirement income plan, broader financial plan, and estate planning as well, right? In terms of the legacy you're going to leave. And then again, we'll finish with the Q&A. So if a question comes up, you can pop that in the Q&A when it comes up, and then we will make sure we get to it. Okay, so you don't have to wait until the end. You can put that question into the Q&A when it comes to you so that you don't forget it. Obviously, we have to cover some important disclosures, right? So 4J Wealth Management we're not a CPA firm or a law firm, so none of this should be construed as legal or accounting or tax advice. It's for informational purposes only. We encourage you, of course, to talk to us and to talk to your CPA if you want to discuss tax planning. And the other thing is we may mention certain investments or broad market returns. Just know, of course, that past performance or what's happened historically is never a guarantee for what's going to happen in the future. Okay, so keep that context in mind when you're listening to this webinar so that you know this is for informational purposes. And then if you want to dig deeper or go further, you can reach out to us or to your lawyer or to your CPA to explore that. Okay, so let's start with what is a Roth IRA, right? Introduction to Roth IRAs. How does it work? Who contribute? So a Roth IRA was actually named after Senator Roth from Delaware, and the law was passed back in 1997. Roth IRAs became eligible in 1998. So this is a pretty new type of account that's recognized by the IRS. And a Roth IRA in and of itself is not an investment. A lot of people get confused thinking a Roth IRA is a type of investment in and of itself. It's not. It's a type of registration or account classification so that the IRS knows, okay, this type of account gets special tax treatment, okay? So how does a Roth IRA work? In general, the way you get money into a Roth IRA, there's two ways primarily, but the one we're going to talk about first is by contributing after-tax dollars to a Roth IRA, okay? And then that money can be invested in the Roth IRA in, mutual funds, exchange-traded funds, index funds, individual stocks. Really, it's very flexible in terms of what you can invest in. And the earnings over the time that money's in the Roth IRA are not taxed. And then as long as you reach 59 and a half and have 5 years where that account has been open, any withdrawals you take out, if you choose to do so, would be tax-free. So after-tax dollars go in, grows tax-deferred, and comes out tax-free as long as you've met those requirements. Now, who can contribute to the Roth? Anyone who has earned income can contribute to a Roth, assuming that they are below the income thresholds, which we're going to cover. But even someone who's in college or a minor, if they have earned income, they can contribute to a Roth IRA, okay? Likewise, if you're over 70 and you're still working and you want to put money away, you can contribute to a Roth IRA, again, subject to being less than those income thresholds that we're going to talk about. The benefits of Roth IRAs. So, I mean, this is a big one. These are very special types of accounts that, and this is obviously the big reason we wanted to devote a webinar to just these types of accounts, because they are really unique from the IRS's perspective and from a tax perspective. So the first big benefit, right, is tax-free growth and tax-free withdrawals. The money that goes in is after tax, so everything beyond that, right, is tax-free, assuming you meet the requirements. The other thing is you don't have to take a certain amount out once you reach a certain age, right? There's no required minimum distributions like there are with 401ks or the TSP or traditional IRAs. Those have required minimum distribution. So once you get to age 73 or 75, depending on when you were born, you have to take out a certain amount of money every year to avoid a pretty large penalty. That's not the case with Roths. There are currently no RMDs that are required. Additionally, and this is where the kind of flexibility of the Roth really, I think, makes it unique. You can actually, right, you don't necessarily want to do this, but you have the flexibility to take withdrawals before 59 and a half and avoid penalty or tax as long as you're withdrawing just the contributions that you've put in. Why? Because that's after tax. Right? So that money you put in, your contributions are after tax. So if I've put in $55,000 over 10 years, the account hypothetically has grown to 150,000 and I need the money, right? And let's just say I can't go somewhere else. I could actually, even being 45 years old, pull out $55,000 and there would be no penalty and no tax on that money because it's treated as a FIFO, first in, first out. The contributions are deemed to come out first. That's very unique. Like I mentioned, anyone can contribute who has earned income, even minors. And then it is a really unique asset and valuable asset for estate planning and generational wealth transfer, right? Because of the tax-free nature of the withdrawals that you can take from these accounts. Okay, so let's really kind of compare and contrast the Roth and the traditional versus the traditional so you can understand. And obviously, the major difference comes down to differences in tax treatment. With the Roth, the money that you're putting in is after tax dollars. So you don't get a tax deduction when you contribute to a Roth. With the traditional IRA, usually when you put that money in, okay, you're getting a tax deduction, and then the earnings are growing tax deferred. But when you start withdrawing money out, usually at retirement, okay, then you pay ordinary income tax on anything you withdraw out. So, right, don't put with the traditional IRA, you're getting the deduction, not paying the tax now, getting the tax deferral, but then all of the income that comes out in retirement is taxable. With the Roth, you're saying, no, I'm going to pay the tax up front. I'm going to put this money in, and then I'm going to let it grow tax-free for many, many, many years. Now, again, getting money into the Roth or getting money into the traditional IRA requires you to be below certain income thresholds. So for a Roth IRA, if you're single, the modified adjusted gross income where you start getting phased out is $146,000. Once you get to 161,000, you're phased out and cannot make a Roth IRA contribution. If you're married filing jointly, it's higher, right? 230,000 is where the phase out starts. Over 240, you can't make the Roth IRA contribution, okay? With a traditional IRA, if you're not covered by any work plan and you're self-employed or 1099, you can always make a traditional IRA contribution, even if you're above these limits, okay? And that contribution would be deductible. Now, having said that, if you're self-employed, there's other types of retirement plans and accounts you can have, which will allow you to put in more than what the traditional IRA allows. But right now we're just talking about the Roth versus the traditional. Now, if you are covered by a work plan and you still want to contribute to traditional IRA, you may be able to deduct it if your income is less than the amount shown here. Okay, so if you're single and make less than 77,000, again, based on a modified adjusted gross income calculation, you could put into the IRA and have that be deductible. If you're married filing jointly, again, covered by a work plan, phase out starts at 123,000. And then if you're married filing jointly, but only one spouse is contributing to their 401k plan at work and the other spouse, for example, doesn't have coverage, then the income thresholds are higher. It's actually the same as the Roth for married filing jointly, 230 up to 240. Above that, again, you can still contribute. So unlike the Roth, so this is where it gets a little bit tricky. Unlike the Roth, where you cannot contribute directly to a Roth once you get over those levels, with the IRA, the traditional IRA, you can, but the contribution, if you're above these levels, is not considered to be tax deductible. So it's an after-tax contribution to a traditional IRA. Why would you do that? Well, remember, that money that went in is after tax, but you still get the tax deferral on any earnings, right, that you make on that money over the life of that plan, or at least until you start taking out at 59 and a half. So it is confusing, right? It's like, well, wait a minute, the traditional IRA is where I'm paying, getting a tax deduction now, and then I'm going to pay taxes when you take it out. Usually that's the case, but there are people who contribute to a traditional IRA even when they cannot deduct it because they want the tax deferral. And there are planning opportunities that we'll talk about later that emerge with your ability to convert that money to a Roth down the road. Withdrawal rules, I pretty much talked about, right? That's how you get the money out of the Roth versus the traditional IRA. Again, in general, traditional IRA, when it comes out, it's going to be taxable. With the Roth, it's going to be tax-free, okay? So here's kind of a flow chart that we can follow. Should I contribute to my Roth IRA versus my traditional IRA? And I think, this is a little bit in the weeds, but I think this is helpful from the perspective that it puts out there some of the key things you should be thinking about when you decide, okay, which way do I want to go, assuming you can do both. So it starts with, are you eligible to contribute to a Roth and a traditional IRA, right? If the answer is no, well, then immediately it's, okay, if you can only make a non-deductible traditional IRA contribution, you can do that, and then you can subsequently convert that IRA into a Roth IRA. Okay, well, we're going to come back to that. But, right, if you can't make eligible contribution to either, then you kind of only have one option, which is the non-deductible IRA contribution. If you are eligible, okay, then are you eligible to deduct your traditional IRA contribution? If the answer is no, because you make too much, you're right back to this. If the answer is yes, you are eligible, then this is the key question, is do you expect your future marginal tax rates to be higher than your current rates, right? If the answer is yes, then a Roth IRA makes a lot of sense, right? Because you're paying after-tax dollars at a rate lower than what you're going to be taxed at in the future, where you can pull it out tax-free. If the answer is no, right, you think that you have good income now and it will be lower in retirement, then you probably want to look at making a traditional IRA contribution, right, where you then can deduct it. Now, one of the big benefits of having some money in the Roth, okay, is that when you get to retirement, we have seen situations where clients have done a great job savings, right? They've followed the rules, they started early, they invested properly, but they have all of their money in pre-tax, tax-deferred accounts where when they pull that money out, it's all going to be subject to tax. So having some money in the Roth, even more than just a little bit, right? More than just a little sum, but just a chunk in the Roth, even if it's not as big as your traditional retirement account funds, is helpful because it gives you some flexibility in retirement from a tax diversification standpoint, where if taxes are lower than expected, you can pull from your traditional IRA sources where it's going to be taxable. But if taxes go up for a period of time higher than expected or just generally high, you could pull money from the Roth, right, which would be tax-free, and then hopefully wait for a later point in time where the tax rates will drop again. Because in general, taxes have been trending. Everyone's talking about them going higher in the future, but it hasn't happened yet. But they can move, right? They were higher before 2016, then they dropped lower. And now at the end of 2025, they're scheduled to go higher unless they extend the tax cuts. So this is a good framework, I think, to think about, should I contribute to the Roth? Should I contribute to the traditional IRA? What are the different puts and takes? Remember, a Roth IRA, like I mentioned, is not in and of itself an investment. It's a type of account registration that allows for special tax treatment. That's what a Roth IRA is. So in terms of how you want to invest that money, your asset allocation, because this is generally speaking something that's longer term, right? Because it's tax free, we think it makes sense to focus the portfolio more on a growth orientation, especially during that accumulation phase, with the idea that higher returns result in greater earnings, i.e. growth in your capital, that will be tax-free when withdrawn. And of course, right, the idea is because you have this unique tax-free nature of the Roth IRA, it should usually, not always, but usually be one of the last types of accounts you consider withdrawing from because, right, it's such a special deal from a tax perspective. And then while we do think it makes more sense to focus on growth, you do want to be careful, right? Because some people will try to shoot for the moon, and if you're not properly diversified, you actually can that can backfire, right? Because if you're only maximizing growth and you take a huge swing and you miss, you're borderlining speculating, and that can lead to a permanent loss of capital where, right, stocks go down and they don't come back. Okay, so being properly diversified, even if you have a focus on growth, it does make sense. Now, there is an example I want to share just because I think it's kind of shows the power of these accounts with good planning. There is a venture capital investor who's pretty famous. I'm not going to say his name, but was an early founder at PayPal, early investor in Facebook. And he put those investments while they were still private into his Roth IRA. And even though it was a small dollar amount, because you can only put so much in, those investments have compounded on themselves, many, 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 many times over. And so now this gentleman, I believe, has, $1 billion+ in his Roth IRA. It's sparked a lot of conversation in Washington about, oh my God, well, this wasn't the intention, but he knew the rules. He knew there was a good chance that these investments would really do well, and they did. And now that all of that earnings, which 99% of those accounts are just growth in earnings, that's all tax-free upon withdrawal. So again, that's a unique situation with a unique investor, but it does show the power if you can have that much money in something where you pull it out and don't pay income tax. It's a very, very powerful thing. And then obviously rebalancing, right? You want to make sure with these accounts, okay, I'm focused on growth, I'm diversified, but you still want to have some sort of rebalancing, I think, that occurs on an annual basis to bring the portfolio back into balance so that it doesn't get too skewed into any one particular investment, right? And again, if you do have a big gain, and you sell and rebalance, you don't have to worry about capital gains because it's in the Roth IRA wrapper, right? So you don't pay taxes on it for sales that occur while it's in there. What are the Roth IRA contribution limits? So for 2024, if you're under 50, the annual contribution limit is $7,000 per person per year. The catch-up contribution for people 50 and older is an additional 1,000, so that would be 8,000, or 16,000 for a married couple. And then there are also, at most larger employers, okay, something. So if you have the TSP or a 401k or even a 403b, usually you can talk to your plan provider, but usually there is a Roth option. So a Roth 401k or a Roth 403b or a Roth TSP. And the contribution limits not only are significantly higher, but you're not phased out as a result of how much you make. Okay. And again, it's still, you're putting after-tax money in. So if you're right now doing a regular 401k and you switch to a Roth 401k, your take-home pay is going to go down because you're getting a deduction with the traditional contribution, whereas with the Roth, it's after tax. But the amounts are high. I mean, it's $23,000 per person per year, and if you're over 50, there's an additional $7,500 catch-up for a total of $30,500. So let's say one spouse has retired, the other one's still working, right? Your income and income tax will be lower than you might be used to paying because you only have one income. Well, that might be a good time to look at, I'm going to take my 401k deferral and put it into the Roth with the idea that I'm not getting as much of a tax deduction as I was when we were both working, right? Or even just say, you know what, I think taxes are going to be higher for me based on what my financial plan and situation is looking like. So I'm going to contribute to a Roth 401k to again build that tax diversification for retirement, so I could pull those funds tax free once I get past age 59 and a half. So we've really only talked about getting money into a Roth IRA through Roth IRA contributions, which is, right, that's typically how people think about, well, how else would I get money into a Roth? There is another way, right? It's called a Roth IRA conversion. Now, what is a Roth IRA conversion? What does that even mean? It means you're transferring money, okay, or converting money from a traditional IRA or a 401k or a traditional 403b, anything where the money is pre-tax, tax deferred, right? No tax has been taken out. And you're converting that into a Roth IRA. You're transferring it directly from that type of account into a Roth. What happens when you do that? Okay, well, one, the reason you would want to do that is you're changing the tax treatment on that account from one that's tax deferred to one that will be tax free. Okay. The con is that you do pay income taxes, right, on any amount you convert, which is, so if you have an IRA where it's only been funded with tax deductible contributions and then it's grown, you're going to pay income taxes on any amount that you convert in that year. So it's just going to be added to your taxable income. Even if you're under 59 and a half, you can do this Roth conversion. You don't pay a penalty, but you will pay taxes, okay? And a lot of people don't realize that come April 15th, they get, all of a sudden they have a big tax bill they owe. It's usually because of this conversion, which they hadn't done in previous years. So it can be a great planning strategy where we usually look at it and recommend it to clients is after they've retired, but before they've started taking Social Security and before they have to start taking the requirement of distributions. A lot of times there's that window, we call it the gap years, where people will have, very low taxable income. And so that gives them the ability to reposition, right? Reposition their balance sheet and move money from the traditional IRA, convert it to a Roth and pay, in the 10 or 12% tax bracket is the idea. So that when they have to start taking RMDs, right, they might be in the 24% bracket. Obviously, getting out and paying 10 and then having it grow tax-free is better than that. So it's a case-by-case basis. There's no perfect answer for this, but that's where we see the window being the most opportunistic. And then keep in mind, each conversion you do is subject to a 5-year holding period before you can pull the earnings out, right, tax-free. This is not normally an issue because when people convert, right, they're not planning on touching the Roth for a while anyway, but it is something to know. Now, anything that you've converted means you pay tax on it, similar to taking the contributions out first if you need to. That amount you could take out first. It's just when you start going into the earnings, right, the growth of the account, that's when the penalty would potentially kick in unless you've met this 5-year holding period. I kind of went into the tax implications of the Roth conversion. The tax implications are you got to pay tax on it now to get it into that Roth structure to grow tax-free. Okay, so we're going to start talking about something called the backdoor Roth IRA contribution. So the backdoor Roth IRA contribution is a situation where you make too much to contribute to a Roth IRA. And let's say in this example, you have just 401ks and 403bs. You don't have any outside IRAs. This is important. And you say, okay, I've done what I can with my retirement accounts. Now I want to try to do a Roth, but I make too much. What you would do in that situation is, remember, with a traditional IRA, you can contribute, right, the full amount, the 7,000 or 8,000 if you're over 50, even if you make well above the income thresholds. It's just that it's not deductible. So you're essentially putting after-tax money into a traditional IRA. So now you have a traditional IRA with after-tax money in. Once it's in there, maybe it's a week later, maybe it's a month later, but pretty soon thereafter, you decide, you know what? I want to convert this to a Roth IRA. Now, assuming you have no other IRAs, they're going to look at that one IRA and say, well, how much of this is after tax and how much of this is, earnings? Well, if you've just put it in a month ago, you probably basically the entire thing is after tax. So when you go to convert it, you get it into the Roth IRA and none of it you wouldn't pay any additional tax, because when you put it into the traditional IRA, it was already after taxes. Okay, that's a backdoor Roth. So people do that. They put it into the traditional IRA, not deductible, do the conversion, same thing next year. Put it in, do the conversion, put it in, do the conversion. Now I'm going to spend a second here because this is where it gets confusing. Let's say I have a 401k, actively contributing to it, that's fine. But I also have an IRA because I worked at a couple of jobs previously and I just wanted to consolidate to an IRA and have flexibility to invest it the way I wanted. So now I've got a 401k and an IRA and I want to get money into the Roth. Well, now under the same circumstance, let's say I make too much, so I contribute to my IRA and the amount I contribute is not deductible. Okay, well now I have a situation. Let's say in that IRA there was 92,000 and now I just put in 8,000, okay, or 7,000, so it's roughly 100,000. If I now go to convert 6,000, 7,000, whatever it is, the way that the IRS is going to look at that is going to look at the majority of whatever you convert. It's actually a pro rata calculation, is going to be actually earnings, right? Because before you put that money in, everything else that was in the IRA had never been taxed. And then you put in an after-tax contribution. So if you say, well, I'm just going to convert the 7 that I put in, they don't look at it that way. It's kind of like you have your coffee and you put your creamer in, it's all mixed together. So it basically would be, only 8% of whatever you decided to convert would not be taxable. Everything else would be taxable, right? So if you converted $10,000, okay, then 800 of it would convert without tax, but everything else would be taxable and show up on your return. So that's where it gets a little bit tricky with the Roth conversions, is you have to be aware of any other traditional IRA accounts you have that are pre-tax and tax-deferred. Most people get the majority of their money into a traditional IRA through a rollover from an old 401k, which by definition, right, is almost always pre-tax, tax-deferred money. It's never been taxed. And that's what creates this issue. I realize it's a little bit confusing, but we can follow up if you have questions in the Q&A to clarify it. But it is a little bit confusing. So I'm trying to make it as simple as possible, but it's not terribly simple, unfortunately. Shocking with our tax code, it's not that simple, but this gives you a flavor for it. The Roth IRA withdrawal rules, again, if you're 59 and a half or older and you've had the account for 5 years, even if you have 5 different Roth IRA accounts, as long as the first one you had was open at least 5 years ago, you're in the clear for all of them. All right. Penalties for early withdrawal, right? The earnings, never the contributions, because those are after tax, but the earnings could be subject to a tax and 10% penalty. But remember, withdrawals follow the FIFO rule. So your contributions are deemed to come out first for anything you take out. Okay. And then there are some exceptions to the early withdrawal penalty at first time. They're very rare, but first time home purchase, qualified education expenses, total and complete disability. If your unreimbursed medical expenses, I think, exceed 7.5% of your adjusted gross income, again, that would be an exception to the early withdrawal penalty, but it's few and far between. And the first time home purchase, I think it's only up to $10,000 that would be an exception. And again, you want to always look at this in the context of your financial plan, because you probably don't want to take that money anyway from the Roth unless you absolutely need it. So Roth IRAs and estate planning, right? This is where I think the icing on the cake is for the Roth IRA, because you can pass on a Roth to heirs, and not only has all that money grown tax-free over your life, but any withdrawals that they take are also tax-free. Okay. If you leave a Roth to a minor, so inherited Roth IRA rules, excuse me, not to it. Let's just say an adult child, a non-spouse beneficiary, an adult child. If you've already, the kids, okay, who are getting this account may be required to take required minimum distributions, right? A small amount each year. But in addition, and this is, I think, the big picture here, is that within 10 years following the year of the original donor's death, non-spouse beneficiaries will be required to withdraw all assets out of the inherited Roth IRA structure. Now, so that's a new rule from the Secure Act that didn't used to exist. It used to be you could stretch it out over your entire life. Now there's this 10-year window. Now, even with that 10-year window, anything you would draw out, it's still tax-free, okay? But it essentially removes it from that Roth IRA wrapper, which then means any future growth, okay, on the money you've put out, if you reinvest it, would then be taxable. But it's still really good. And then the thing I like to point out is, if you're at a point where you have grandchildren who are, fairly responsible, either as teenagers, it's kind of an oxymoron, but somewhat responsible young adults, I think it's even more powerful, right? Because you can even have more tax-free growth. It works over a longer period of time. So leaving Roth IRAs to young adult children, or slightly older grandchildren, or even not, like maybe you just say, well, I'm okay leaving it to a grandchild. The parent will watch over until they get to 18, and then it will have to be distributed. It depends on your family situation. But again, by leaving it to younger generations, it allows for that maximum tax-free growth, right? To maximize that tax-free growth. Now, there is something that occurred very recently, where now you can, a 529 plan, which has always been a type of account designated for higher education expenses. So you put the money in, it grows tax deferred, and then it comes out tax-free as long as it's used for qualified education expenses. Many people did these 529s, and then they may have money left over in those plans even after their kids are out of college and out of graduate school, if they go. And so what this provision allows is for a 529 plan to move over to a Roth IRA, a 529 to Roth IRA conversion. But there's a lot of different stipulations. The big ones are the account has to have been open for at least 15 years. Any dollar amount transferred, okay, has to have been in the account for at least 5 years, meaning any dollar amount transferred from the 529 to the Roth has to have been there for at least 5 years. And then the beneficiary has to have earned income for the tax year in question, right? So if I have a 529 plan for my son or daughter, and I want to eventually do this conversion, I can't just do it if they don't have any earned income. They have to have earned income, which means they have to be working, and then this can occur. So here's kind of goes into all the different permutations of can I make a 529 to Roth IRA transfer, right? So the first one is, has the 529 account been open for at least 15 years? Let's say it has, yes. Has the dollar amount you plan to transfer from the 529 to the Roth been in the 529 account for at least 5 years? If it's yes, again, we go up here to the top. Are the beneficiary of your 529 account, so in my case, let's say my son, and the account owner of the Roth IRA, you plan to transfer the same person? If it's a yes, has the beneficiary had earned income for the tax year in question? Yes. Okay, a lot of steps. So now the amount you can transfer from the 529 account to the Roth is limited to the beneficiary's earned income or the Roth IRA contribution limit, whichever is lower. So if the beneficiary made $10,000, right, then you can transfer 7, which is the Roth IRA contribution cap. Keep in mind, if they've made any other traditional Roth contributions for the tax year in question, you need to back that out, okay? If it's no, has the beneficiary ever received other 529 Roth IRA? No, yes, you're eligible. But the point is, like, this stuff is not just, oh yeah, I have a 529, funds left over, I'll just move it to the Roth. It's not that simple. You have to go through these steps. The most you can convert over the entire life of that 529 is 35,000 to the beneficiary, okay? And then each year, right, you're capped at the earned income or Roth IRA contribution limit, whichever is lower. So it's still a nice benefit, especially for funds otherwise that are just stuck in there, but it's not like a game changer. I don't think. I guess if you got 35,000 in right when the kid was out of school, 22 to 26 or 7, and then that money grew tax-free and earned a healthy rate of return, it could be meaningful at retirement, but it's still not a huge amount, and it has to be around a long time. There's lots of different stipulations that have to be met. All right, let's go ahead and open it up to Q&A. I don't know if there's other questions that are coming in as we speak, but we can go ahead and open it up. I can actually read these. Okay. Why would I choose to contribute to a traditional IRA if I exceed the income threshold versus a non-retirement account? Good question. So what this question is getting at is, why would I contribute to a traditional IRA if I can't deduct it versus just putting it into a brokerage account? It's a very legitimate question. The only reason you would want to do it is, one, if you're aiming to do some sort of a Roth IRA conversion, or you feel like the tax deferral benefit that you're going to get on the growth of that investment will be more important than having a brokerage account where you have to deal with capital gains. But I would say that really is a good question, because on a case-by-case basis, I've definitely seen situations where it is better to just put the after-tax money into a brokerage account. If you're doing more buy and hold type of investing, you're effectively getting tax deferral just by not selling that position and having that unrealized capital gain grow tax deferred. So the only reason would be, again, you're really prioritizing that tax deferred growth, and you potentially want to look at doing some sort of a Roth conversion, but it's a good question. If you convert to a Roth but die before the 5 years have passed, does the account still go to the beneficiary survivor? Yes, it would. it would still go to the beneficiary survivor, and they would still be, my understanding of that is not only would it go to them, but it would still be tax-free to them. Is the right to convert from the Roth IRA, is the right to convert from IRA to Roth IRA based upon earned income or taxable income? Is investment and considered earned income? Okay, so you can always, it doesn't matter how high your income is, the IRS has no problem with you converting money from an IRA to a Roth. Okay, the conversion is not, there's no phase out of income if you do the conversion, right? Because you're essentially paying the taxes when you do that conversion to the Roth. So they're okay with that. So maybe I misunderstood that question, or you want to clarify that. But you can always do the conversion from the IRA to the Roth. The only time you can't is you cannot take an inherited IRA and convert that to a Roth. That is not allowed, right? Where you have an IRA as a result of inheriting it from, a parent, for example. So it's in an inherited IRA in your name. You cannot then convert that to a Roth. Did that answer that question, Joe? He's probably typing. Any other questions? That looks like another one came in.
He said yes, answered it.
Yes, answered it. Okay, good. Are there any other questions? We've had 4 or 5 come in, but this is your opportunity. If you have any questions, you can also email us. But it is normally really beneficial to ask your questions if you're comfortable in this format, because everyone gets the benefit of hearing the answers, even if they haven't thought about it. Anything, Jeffrey? Anything come in?
One last question, I think, Josh.
Yes. So couples can potentially put in 16K for a Roth. There's a couple things going on there, right? So it's 7K, but then there's a catch up of 1,000. So that would be 8,000 for an individual. So if the couple's both over 50, each member's over 50, and their modified adjusted gross income is less than 230,000, they can then each put in 8,000 or 16,000 a family into a Roth IRA. Yes. But there are those conditions that, it's not just any couple can put in 16,000 to a Roth, right? You have to be over 50, each of you, and you have to make less than that 230,000. Remember, if you work for your employer and they have a Roth option, you could do even more, right? So keep that in mind. There's a Roth TSP. There's a lot of accounts that have a Roth 401k. There you can do, right, 23,000, and then if you're over 50, another 7,500 all into the Roth, if that makes sense for your financial plan. And then when you retire or leave the employer, you can just roll that over into a Roth IRA. So good. All right. It sounds like a lot of good questions, and sounds like they've been answered. Does anyone else have any questions? Anything at all about Roth IRAs? All right. Well, we will get out a little early today from class. So thank you all for attending. We really appreciate it. And, I think this particular subject on Roth IRAs is really important, just because everyone's kind of heard of the Roth, but not many people really understand it, I think, at a detailed level. So one last question. Do Roths make sense if you're retired? So remember, if you're talking about contributing to a Roth, you have to have earned income. So if you're retired, right, you couldn't contribute to a Roth, you don't earn income, but you could do the Roth conversion. And so that we do think that can make a ton of sense, the Roth conversion, assuming, right, your taxable income in retirement because you haven't yet started taking RMDs, et cetera, is low. If you're in that 10 to 12% bracket, and if you do nothing and then RMDs start and you're going to jump to the 24+%, Roth IRA conversions can be really compelling, even in retirement, right? But it would have to be a Roth IRA conversion you're doing versus a Roth IRA contribution, because you don't have earned income in retirement. You probably have passive income. So hopefully that answers that. That was a good question. Kind of covered that, but again, there's a lot we're talking about here, so it's easy to lose the thread. Could a non-working spouse contribute to Roth if the spouse is working? Yes, it's called a spousal Roth contribution, but you're still subject to that, right? That as long as the modified adjusted gross income is below the 230,000. So a non-working spouse, it's a spousal Roth IRA contribution, can take advantage of that. Yes, but it is on a case-by-case basis. So it would be helpful to know your specifics there. Jeff, anything that came to mind for you?
No, I think you covered it all.
Okay.
In depth way. But sound good, man.
Well, questions are kind of trickling in, so I'm going to hang out for a little bit. But I think we're pretty much at the end. So again, right, we're going to make this available, the recording available, so you can watch it again and go through the slides. And then if you do have questions that come about after the fact, feel free to send us an email and we'll be happy to address them for you. So thank you again. We really appreciate it. We'll see everybody in April for our next webinar. And yeah, really appreciate it. Bye, guys.